Good
Good
evening.
evening, Sanjeev sir.
Yes, sir.
Good evening. Good evening.
Everyone. I welcome you all on this hot burning topic today on tax audit issues. For this, we are having with us as a today's speaker and faculty, CA Sanjeev Mutha sir, who is already very closely associated with Ahmednagar branch. And I welcome you all for this webinar. Today's topic will enlighten us the various amendments as well as the complexities in the tax audit, and it will help in the coming days. Now I request Deepak Agarwal sir to introduce our today's speaker, Sanjeev Mutha sir.
Yes. Thank you, Kiran bhai. Good evening, everyone. It is my pleasure to once again welcome Sanjeev Mutha sir.
Thank you.
Last year we were blessed to have him at Akola branch for this seminar only, income tax audit. Now again this year sir has come and given his availability, so it's a very happy moment for us. And sir, from this you can understand that your liking within our members is more now. You are in Nashik, but still you have got a fan following in Akola now. So let me give a formal introduction of Sanjeev Mutha sir.
Deepak sir, I want to add that sir की ससुराल अहमदनगर में है.
अच्छा फिर आपका रिश्ता बड़ा है सर. Sanjeev Mutha sir is a practicing chartered accountant with almost 30 years of experience. He is a senior chartered accountant a senior partner at SS Mutha and Company Chartered Accountants, Nashik. Sir is also past chairman of Nashik branch of WIRC of ICAI for the year 12-13. Sir is primarily into practice of direct taxation and is handling various matters with CIT appeals and tribunal tax planning and income tax raid cases as well. He is also practicing in business restructuring processes. He has delivered various lectures at various branches of WIRC as well as with many trade associations also. Sir was a part of the editorial committee of WIRC, as well as sir was the part of committee for double entry accounting system for local bodies. Sir is a avid tracker. Sir is a fitness enthusiast. Sir is a cricket follower, music follower. Plus, he has got liking for trekking as well as adventure sports. So with so from this we can understand he is a very versatile personality with a deep, thorough knowledge on the subject of income tax, and we are privileged to have you, sir, once again. And I welcome you on behalf of all the three branches.
Deepak sir, I want to just add one more thing about Sanju sir is that Sanju sir is the only person I have seen who is so much having a knowledge in double accounting for the local bodies.
Correct.
He has prepared his own software also, okay, and he is having a very deep knowledge in this field. And he has already implemented in Nashik Municipal Corporation.
Very good. Great,
sir is having such a great faculty for us. Yes, sir. Sanju sir, you can take over the charge.
Thank you so much. Shall I share my screen?
Yes, sir. Yes, sir. You can share your screen.
Okay. At the outset, I'm very much thankful to Akola branch, Amravati branch, as well as Ahmednagar branch for giving me this opportunity to share my views on the topic allotted to me, that is issues under tax audit. Let me share my screen.
Sir, are you able to share?
Yeah, whether it is
yes.
Whether it is
sir, we are able to see, sir. Yes, sir. Yes, sir.
Okay. So,
sir, only make the full window.
I'm trying. Hi, is it okay now?
Yeah. Yes, sir. Okay. Perfect.
Yeah, it's okay. As far as official area is concerned, in my considered view, tax audit is very important because our considerable source of practice is dependent upon tax audit, what I believe. Now, instead of discussing the topic on clauses as well as provisions of law, it is better that we should take up issues directly and to understand the subject. So first of all, we know what is the applicability of the tax audit. There are 5 things where the tax audit is applicable. I will just take overview quickly that in case of business, when turnover exceeds rupees 1 crore rupees, in case of profession, when gross receipt exceeds rupees 50 lakhs, or if the income is not shown at the rates stated in 44 for section 44 AD, that is 6% or 8%, and same case in case of profession, if the profit is net surplus is not shown at the rate of 50%, and cases covered by section 44A, 44BB, 44BBB.
Yes, just
Kiran sir, can you unmute mute other one?
yeah. Just 1 minute.
Am I audible?
Yes, sir. You are audible, sir.
Now there is very important amendment by Finance Act 2020 to remove the hardship where the turnover is more than 1 crore rupees but less than 5 crore rupees, and aggregate of all amounts received, including amount received on account of sale, turnover, gross receipt, etc., and aggregate of all payments, including amount for purchases, expenditure, is in cash is less than, it is not exceeding 5%. In that case, the assessee is not required to get books of account audited. I repeat, when turnover is less than 5 crore rupees but more than 1 crore rupees in case of business, and total outgo in cash, outgo and income is not exceeding 5%, then this assessee is not required to get his books of accounts audited. Now we will directly take certain case studies. The turnover of an individual is rupees 60 lakh rupees. To understand the subject, we will go directly on cases. In one case, the turnover of individual is 60 lakh rupees and net profit is 2 lakh rupees. That is less than 6%. And his other income is 5,000 rupees, which he is after deduction, his return income is rupees 2 lakh rupees. The question is whether he is required to get books of account audited, because he is businessman, his turnover is less than 2 crore rupees, but he has not shown profit at the rate of 6%. The answer is no. Even though in this case, the assessee has not shown profit at the rate of 6%, but his total income is less than taxable limit. That is maximum amount not chargeable to tax, that is rupees 2,50,000 rupees. Because the condition is that the audit is applicable in the case where the cases covered by section 44 AD, where the turnover is less than 2 crore rupees and he has not shown profit at the rate of 6% or 8%. But one more condition is that his total income should be more than taxable limit. If his total income is not above the taxable limit, even though he has shown profit less than the 6% or 8%, the audit is not applicable. In the present case, as he has shown profit, his total income is less than rupees 2,50,000 rupees. Therefore, audit in this case is not applicable. Now, going further, in the same case, if the turnover is more than 2 crore rupees, but profit is say 2 lakh rupees, so his total income is not chargeable to tax. Whether audit is applicable, in the second case, audit is applicable, because the condition of having income more than 2,50,000, that is taxable limit, is applicable to the cases covered by section 44 AD. If the case is not covered by section 44 AD, if the turnover is more than 1 crore rupees, then audit is applicable because of subclause of section 44 AB. Okay. Now, in another case, the turnover is 1 crore 50 lakh rupees. Net profit from business is 1 lakh 50,000 rupees. That is only 1%. So profit is 1% only, but that person is also having rental income. The taxable amount which is rupees 1 lakh 40,000 rupees. So rent is 2 lakh rupees after 30% deduction. His rent income taxable is 1 lakh 40,000 rupees. Income from business is 1 lakh 50,000 rupees. Total is 2 lakh 90,000 rupees. So here, even though his profit from business is less than the taxable limit, but total income is more than 2 lakh 50,000 rupees. The total income is more than taxable limit. Therefore, in this case, audit is applicable. The third case, where If a person is transporter, he is having 2 trucks. He has maintained books of accounts and his net profit is 1 lakh rupees. That is less than the amount as per section 44A. His total income is also rupees 1 lakh rupees. In this case, the criteria given in section 44 AD is not applicable because there is no mentioning like that the income should be above the taxable limit. Therefore, in case of truck owner, if income is not shown as per section 44 AE, he is required to get books of account audited. That benefit of requirement of income above the taxable limit is not available in the case of transport contractors. Now, one more example. Turnover is 60 lakhs rupees, net profit is 3 lakhs rupees. The books of accounts are not audited. In the course of scrutiny assessment, whether AO can consider profit at the rate of 8% or 6% directly, the answer is no. Because if addition is to be made, then it is to be made on the basis of evidences. At the most, in the present case, as the assessee has shown profit less than 6% or 8%, and he has not audited his books of account, at the most, the AO can initiate the proceedings under section 271 capital B, that is penalty proceeding. But he cannot increase directly income to 8% or 6% without evidence. There are 3 examples. Just I am trying to make out the case to understand the concept of applicability of section 44 AB. In one case, there are 2 activities of that assessee. He is doing business and he is also doing profession. In case of business, his turnover is 1.85 crore and professional gross receipts are 20 lakhs rupees. So total is 2 crore 5 lakh rupees. So total is exceeding 1 crore or 2 crore rupees. Whether audit is applicable if the assessee in this case opted 44 AD for his business purpose, business, and 44 ADA for professional, that question audit does not arise. Even though his total turnover exceeds the total threshold limit. But what is important in section 44 AB is to be seen qua business or qua profession. I will come, this fact is proved with the help of, can be proved with the help of form 3CD. When I will come to form number 3CD, I will show how it is proved. But what is to be seen qua business or qua profession. In the case of business, the turnover is less than 2 crore rupees. He has opted for 6% or 8%. So audit is not necessary in case of business. For profession, gross receipts are less than 50 lakh rupees. He has opted to show 50% profit. The audit is not required. In case of second example, his turnover from business is 2.2 crores, 2 crore 20 lakhs rupees, and gross receipts from profession is 30 lakhs rupees. In this case, if he desires, he can opt section 44 ADA 50% profit for in case of profession. But for business, he has to get his books of account audited because the turnover has exceeded the threshold limit of 2.2 crores, 2 crores. And in case of third example, the same case is that the profession gross receipt has exceeded 50 lakhs rupees. He has to get the books of account audited in respect of profession because his gross receipts are more than 50 lakh rupees. But in case of business, his turnover is 80 lakhs rupees. Therefore, he can opt for section 44 AD for business purpose. And if he require, even though for profession or business, if you want that he don't want to opt for 44 AD or 44 ADA, he can get books of audited in case of both the concerns.
Yes, sir. Please continue, sir.
Yes, in case of estate agent, finance broker, commission, brokerage received by and treated as whether to treat them business, turnover, or professional receipts. Now, there is 44 ADA is applicable to only specified profession. It is not applicable to all professions. In whether activity is business or profession, it will depend upon the facts and circumstances of the case. There can be a situation that one activity, if carried on by Mr. A, can be regarded as professional activity, and same activity, if carried on by Mr. B, can be regarded as business activity. I'll give one example that coaching classes. If one person is conducting coaching classes himself, he's applying his own skill, then it can be his professional income. But if he has employed certain staff to teach the students, then it can be regarded as business activity. So it depends upon fact and circumstances of the case. Same case is the case of estate agent or share broker. If share broker commission income is he is earning commission income on the in case of share transaction on the basis of his infrastructure. So even though his income is nomenclature of commission, it is not profession, it is a business. In case of other business, it is also they are getting commission or brokerage out of their infrastructure. It is not application of that much skill which is seen, which is required to characterize them as profession. Therefore, it depends upon facts and circumstances of the case. Now, in case of another example, we know especially in USA, they are following calendar year. And US companies which are there in India, they are also compulsorily following calendar year. I have not seen any exception to this. Now, if they are auditing their case for calendar year, for example, they are audited for the year 2019 up to December 2019. Now, in India, they have to file return of income compulsorily on the basis of financial year. Then what to do for the next 3 months? Because audit is to be done from 1st April 2019 to 31st March 2020. And they have audited only up to 31st December 2019 because they are following calendar year. So there is a circular number 561 in which it is stated by CBDT that the tax auditor has to audit for the balance 3 months and he has to give report. And in the last example of this slide, the assessee is carrying on business and also profession, then whether to furnish single or separate audit report. Even though assessee is carrying on separate multiple business or multiple profession or maybe business and profession, he has to issue single audit report in respect of his activity. Now, there are certain problems. For example, question is asked method of accounting and window is given. Window has given only mercantile or cash system. Window has given only one system, mercantile or cash system. But there can be a situation that for business, the assessee is following mercantile system of accounting, and for profession, he is carrying on cash system of accounting. Then in that case, as you don't have option, you just give a thought that which is the substantial activity, just mention in CCD that he is following suppose mercantile system of accounting and give suitable finding in form number 3CB or 3CA, which is where you have to give finding in respect of form number 3CD. But here my words is that in case of multiple business or multiple profession, there is no requirement to furnish separate audit report. A composite audit report has to be furnished. Now, one more example as regards to new proviso introduced in respect of 5 crore turnover and cash transaction less than 5%. To understand, I have prepared this example. In this case, the total aggregate receipts are 4 crore 30 lakh rupees. See, turnover is 4 crore rupees. Turnover is a basis for applicability of that proviso. So turnover is 4 crore rupees, but total his income, total receipts are 4 crore 30 lakh rupees. There is a sale of fixed asset. He has received certain loans. He has received certain advances, and he might have again received certain amount. Maybe he has received certain amount from as a capital from partners. So total receipts are 4 crore 30 lakhs rupees, and out of which total cash component 8,60,000, which comes to 2%. So it is not exceeding 5%. So as far receipts are concerned, he is fulfilling the criteria. Now, as far as payments, his total payments are rupees 3 crores. But total cash portion in the payment is 18 lakhs rupees. Payment may be for purchases, payment to creditors, payment, repayment of loan, or payment as advance to customers, and so on and so forth. So it is 3 crore rupees, and cash portion in 3 crore is 18 lakhs rupees, which is coming to 6%. Therefore, the assessee is not fulfilling the condition as regards payment. Therefore, he is not eligible under that proviso. He has to get books of accounts audited. What is condition? That the cash portion in both the case, receipt and payment, should not exceed 5%. Here, the payment here, that that 5% limit is not fulfilled because he has made total cash payment to different parties on different account more than 5%. But continuing with the example, in the above case, the assessee has purchased shares by check worth rupees 1 crore rupees. Now total payment, what is shown in the above table is 3 crore rupees plus purchase of shares 1 crore rupees. So total payment now has become rupees 4 crore rupees. And if we compare this cash portion to 4 crore rupees, it comes to 4.5%. So in this case, assessee is fulfilling all the condition, audit is not required to be done. Here, my point is that the assessee has invested into shares of some different company not connected with her business. Here, assessee is lady Miss Seema. Whether that share investment should be considered or can be considered for the purpose of calculating the cash portion or not, this is a moot question in this case. In my opinion, if we read the provisions of law, it has referred to all payments. It has referred to all payments and all income if it is accounted for in the books of accounts. So in my considered view, as there is no specific exclusion given, then I think we should interpret the provisions because this is a beneficial provision. We should interpret in benefit of assessee, and in that case, I think audit is not applicable. One more case, Mr. Ashok has turnover of 3 crore rupees and income of 6 lakhs, that is 2%. His payments and receipt made in cash are 2% of the aggregate payments and receipt. Whether Ashok is liable for tax during the year. See, in this case, his turnover is 3 crore rupees. It is less than 5 crore rupees. His total aggregate payments and receipts are less than 5%. But his profit is 2% only. He is not showing profit at the rate of 6% or 8%. In this case, also, he is not required to get his books of account audited because there is no condition given as regard profit to be shown in this type of cases. So there can be loss, there can be profit. If he is fulfilling the condition, turnover is less than 5 crore rupees and total receipts and payments are the cash portion in total payments and receipts is not exceeding 5%, he is not required to get his books of account audited. Now, important question, while it's the next issue, while calculating cash component in receipt and payment, how opening debtors, creditors, provisions, receivable, etc., as well as closing debtors, creditors, provision, receivable are to be considered. Because in case of current year, I might have made provision for substantial expenses which are not paid during the year. There can be situation that out of opening debtors, say of rupees 5 lakh rupees, I have received 5 lakh in cash. But that 5 lakh are pertaining to the earlier year, not this year. What is to be considered? Whether transaction connected with the current year or transaction entered during the year, irrespective of the year to which it pertains. So I think there is no ambiguity. The transaction entered during the current year are to be considered irrespective of the year to which it pertains. There can be a situation that the assessee has paid opening creditors. The assessee has received amount from the opening sundry debtors. The assessee has made repayment of opening loan. There can be payment of opening provision. There can be a provision made during the year. That will not be considered. What is important? Only what amount is received during the year, what amount is paid during the year, and what is the cash portion in that. The year to which the said payment pertains is irrelevant. Now, whether cash deposited as capital with or withdrawn from capital account by partner shall be considered? Yes, because for the purpose of Income Tax Act, partners are separate from firm. So if firm has received any capital in cash, so that will be counted as cash portion received during the year. And for the purpose of calculation of 5% of cash portion, this capital contribution in cash would also be considered. Same is the case when if the payment is made to partner in cash, that will also be considered for the purpose of computation of 5% limit in cash in respect of payment. Therefore, one has to consider entire aspect. Only in my opinion, the transaction with bank are not to be considered because that is the two pockets. Cash is one pocket and bank is another pocket. It is not a payment. We have kept our money in the bank, and if amount is transferred in bank by any other person, that is the bank is acting as our agent. Therefore, the transaction with bank will not be considered as with third party. Therefore, cash withdrawn from bank or cash deposited in the bank would not be considered as transactions. In this case, Mr. Kiran has turnover of 90 lakhs and net profit of 4.5 lakhs during his first year of business. So Mr. Kiran has started new business. In the first year itself, his turnover is 90 lakhs rupees. He has shown profit only 5%. As the profit is not shown at the rate of 6 or 8%, he got his books of account audited for the year. So whether next year, now his turnover is again 90 lakh rupees, now he want to show profit at the rate of 8%. Whether he is required to get books of account audited, because we know if conditions of section 44 AD are not complied with, if you are shown profit less than the rate given in section 44 AD, we have to audit for next 5 years. But this is not applicable in the case where the business is started for the first time in the year. Because if you read the provision of law, that clearly states that the person who has already shown profit under section 44 AD and subsequently if he showed less profit, then for next 5 years he has to get his books of account audited. So what is condition? There are two conditions. First of all, he should have assessed during last 5 years under section 44 AD. And then he should opt out of section 44 AD that he will show less profit than 6% or 8%. Then for next 5 years, he is required to get his books of account audited. But if he has not shown profit during last 5 years under section 44 AD, and during the first year of his business, or during the first year of business, or he is not shown profit under section 44 AD during last 5 years, then in this case, the question, even if he shows profit less than 6%, for next 5 years, he is not required to get his books of account audited. Now, in another case, Dr. Amit has gross receipts of 40 lakhs and net profit of 10 lakhs, that is 25%. In assessment year 2019-20, he got his books of account audited for the year assessment year 2019-20 because he is a doctor and he has not shown profit at the rate of 50%. Therefore, he audited. Now, in assessment year 2020-21, he has gross receipt of 40 lakhs rupees. Now, he wants to show profit at the rate of 50%. And he is regularly assessed to income tax. He has shown profit under section 44 ADA even prior to assessment year 2019-20. So, whether he is required to get books of account audited for next 5 years, the answer is no, because the requirement of the condition of next auditing of next 5 years is applicable to section 44 ADA only, and there is no such provision in section 44 ADA. So therefore, as far as section 44 ADA is concerned, it is at the discretion of the assessee. If profit is shown less than 50%, get books of accounts audited. If in any year he want to show profit at 50% or his profit is 50%, he is not required to get books of account audited. Still, we are into applicability of 44 AB. In this case, Mr. Shahrukh has 5 goods carriage vehicle. This is a question which is asked to me by many persons. Mr. Shahrukh has 5 goods carriage of his own, and also he took 10 goods carriage on lease from others. Whether Shahrukh would be eligible to claim benefit of section 44A of the Act, or in this case, rather than 10 goods carriage vehicle, we will take 2 carriage vehicles. So what is there in this case? Assessee is having 5 his own vehicle, and he also took certain vehicle on hire for his business, and he is doing composite business. So whether he can claim, he can show income under section 44A, the answer is no. Because 44A clearly states that the profit in respect of vehicles owned by him shall be computed as under. Mark the word vehicles owned by him. Therefore, as far as 5 goods carriage vehicles are concerned, he can show profit under section 44A. But in respect of other vehicles which he has hired, still he can go and show that profit under section 44AD. Because 44AD does not preclude him from showing profit in respect of vehicles which is hired by the assessee. Now it is for him how to present the same and how to maintain the record. But 44A is applicable only in respect of goods carrier owned by the assessee, and in case of other transactions carried out with the help of hired vehicle not owned by the assessee, that portion the assessee can always disclose under section 44AD. In another case, it is shown that a farmer is there and his sale of crop is 1 crore 50 lakhs rupees. Whether audit is applicable, the audit is not applicable to agricultural activity, even though his turnover exceeds 1 crore rupees. Now, in the third case, Mr. Makicha Sons LLP has turnover of rupees 60 lakhs and net profit of 60,000. That is only 1%. So, Mr. Makicha Sons carrying on business. Say he is a cloth merchant. They are selling cloth. Their turnover is 60 lakh rupees and they have shown profit of 1%. Whether LLP is required to get books of account audited under section 44 AB of the Act? The answer is no, because 44 AD is not applicable to LLP. In this case, even though the LLP has shown profit less than 6% or 8%, there is no provision whereby the LLP is required to get books of accounts audited under Income Tax Act. So in this case, even though profit is shown at 1%, 2%, 3%, if it is LLP, even though the audit is not required to be done. Here, Mr. Sham is carrying on 2 businesses. One is steel business, turnover is 4 crore rupees. Another is cloth business, turnover is 60 lakh rupees. The income from cloth business has been offered to tax under section 44 AD of the Act. What he has done, cloth business, मुझे 44 AD में दिखाना है. So he has shown 6% or 8%. At the case maybe 8% because cloth business maybe cash sale, and so he has opted 44 AD for cloth business. In this case, whether he can, the provision to section 44 AB can be invoked, and he can claim that my all transactions in respect of steel business are by way of check, or it is not, the cash component not exceeding 5%, and audit is not applicable to me in case of steel business. I think query is that cloth business, there are 2 businesses. Cloth business turnover is 60 lakh rupees, which he has opted for 8%, and steel business is turnover 4 crore rupees, but it is less than 5 crore rupees. The transactions in cash in case of receipts and payment total are less, not exceeding 5%. In that case, in my opinion, the audit is not applicable. Audit is not applicable because he is fulfilling all the conditions. 44 AB is to be seen qua business. 44 applicability of 44 AB is to be seen qua business. But the question is that while calculating the cash component, whether to consider only steel business activity or cloth business activity as well. In my opinion, if separate books of accounts are maintained for steel business and cloth business, then for steel business, the only activities of the steel business would be considered and cloth business would not be considered. But if composite books of accounts are maintained, even if you offer income under section 44 OD in case of cloth business, but as composite books of accounts are maintained, in my opinion, the cash transaction of cloth business would also be considered for calculating the 5% limit. So in case it is advisable to maintain separate books of accounts. Notation which in my opinion is very important, it has been held by Allahabad High Court that all professions are business, but all business are not profession. All professions are business, but all business are not profession. Example, already I have given coaching class. It can be a profession. It can be a profession, it can be a business. A profession can be business, but business cannot be profession, because for profession it requires a process knowledge. For business, it requires infrastructure, may not require. Coming to audit report, we know from, I don't want to deal where from CCA is used or where from CCD is used. Here, in case of from 3CA or 3CB, if we see at clause A, the audited profit and loss account, income expenditure account for the period beginning from and to ending on. If we know the audit under income tax is always for the financial year, so why then statute has not maintained from 1st April to 31st March and only leaving blank space for the year? It is because what happened while giving report, because of cut paste copy, we always mention 1st April 2019 to 31st March 2020. But there can be a situation where LLP or partnership of our company is incorporated during the year under review. Say LLP is formed on 1st October 2019. Then in this case, the books of income expenditure shall be from 1st October 2019 to 31st March 2020. There can be a situation that a person, because of death, a company has gone to liquidation or any firm has dissolved on any particular date. Then in that case, the profit and account would be from 1st April to date on which the firm is dissolved. While giving audit report, we have to verify whether the assessee is incorporated during the year or whether there is a dissolution of the firm. What date is to be mentioned instead of cut paste copy. We know this clause 3, our finding is given with reference to form number 3CD only. We should not mention any other things that we have opted for test check, the bank accounts are subject to confirmation. It is not allowed as far as Form 3C is concerned. It is been specifically mentioned that particulars given in the set 3C are correct subject to the following observation. So here in form number 3CA, the under clause 3, your finding, your observation would be confined only to the form 3CD and it will stuck as regards clause number such as such of form number 3CD and your finding. Because it is necessary that in respect of what clause you are giving your observation, you are giving your qualification. Therefore, we have to mention clause number of form number 3CD and just give your observation, qualification or any comment about. As far as form number 3CB is concerned, we have to give form true and fair view, because in case of form 3CA, it is applicable to the cases where audit is required to be conducted under the any other provisions of the law. But if audit is not conducted under any other provision, then we have to give, the auditor has to give true and fair view. So he has to audit. We have to give our observation, comment, qualification, disclaimer, negative report, etc. What we are giving, whether it is our observation, whether it is a comment, whether it is a qualification, disclaimer, it should emanate out of our wording. What happens, sometimes I have seen certain comments that definitely whether auditor is, he's giving his observation, he's giving his comment, whether it's qualifying, whether it is a disclaimer, it is not emanating out of the wording given by the auditor. Now, there can be a situation that we are auditing for financial year 2019-20, but for financial year 18-19, the books of accounts were not audited. So preceding years accounts were not audited and we are auditing for next financial year. I think the opening balances during the current year are carried forward from next year, which were not audited. So opening balances are not audited. We should give our finding that the preceding year's figures are subject to audit, or there is no audit carried out for the financial diseases and opening balance sheet are subject to audit. Because if we don't mention this comment, it means that we are auditing the opening balances. We are certifying the opening balances. This is my considered view. So in this case, we should give our finding that opening balances are not audited. In case of habitual activity, as seen in case of individual, where audit we are being conducted in respect of his business, and he is also having agricultural activity, and agricultural income on ad hoc basis is credited to capital account. Say agricultural income 2 lakhs rupees, 2,40,000 rupees, 2,56, 284, some maybe odd amount. But there is no any material or evidences in support of this agricultural activity. And I have seen many times there is no note given by the auditor in respect of activity which is not audited by him. Normally, we never audit agricultural activity. So there should be a finding in form number 3CB that we are not audited the agricultural activity in the because the books of accounts or other record in respect of the said activity is not maintained. Otherwise, what would happen? We will certify that agricultural income as well. This is also a very important aspect as far as my opinion is concerned. In case of both statement of affair and balance sheet of an assessee are maintained and only balance sheet is audited, what should the auditor do? There are certain individual cases, they are maintaining books of account only about their business. And they are not maintaining books of account in respect of their statement of affair, that is personal investment. Or they are maintaining two balance sheets. One balance sheet of their business, of which they are proprietor, one their own balance sheet in which they will have transactions of shares, transactions of agricultural land, or they may be partnered in many firms. That capital account of that firm is appearing their personal statement of affair, like that. And in third case, the statement of affair balance sheet, personal balance sheet, not at all maintained. This is, I think, very risky case, because the very important aspect is that again I'm repeating, very important aspect is that the applicability, the turnover is criteria. 2 crore, 5 crore, 6%, 8% profit is a criteria for applicability of tax audit. Once tax audit is applied to individual, then we have to audit entire that individual, not only his business. These are the both two concepts are separate concepts. Applicability of the provisions of section 44AB. So for applicability, there is a criteria of turnover, there is a criteria of profit under section 44AD or 44ADA. Once the audit is applicable, then audit is to be done of that individual. If we see form number 3CB, where we are mentioning permanent account number of that individual. And more particularly, if we see form number 3CD, certain content, those contents are not related to business of the assessee. Example, deduction under chapter 6A. The deduction under chapter 6A has nothing to do with the business of the assessee. We are making investment in LIC, we are claiming deduction. Then section applicability of section 56 to 10. If your property is purchased as less than stamp duty valuation, is there nothing to do with the business of the assessee? It is taxable under the income from other sources, but we have to report. Likewise, there are many things which we are supposed to report, which are not connected with the business of the assessee. Therefore, the business criteria, turnover criteria is only confined to the applicability of section 44AB, and once 44AB provisions are applicable, then we have to audit that individual. Therefore, my considered request is that if we audit entire aspect of that assessee, that would be better. Or if the assessee has maintained statement of affair in which he is recording his personal investment, personal things, that he may be partner in any firm, his capital account is appearing his statement of affair, and he has produced only books of account related to his business for audit purpose, then we have to qualify our report. We have to qualify our report, or we have to report that we have not audited his personal information. Why it is important? Because we have to comment on disallowance under section 14A, and 14A wants that whether there are any assets, the income of which is not chargeable to tax. If that asset is accounted for in his personal statement of affair, how we will mention nil? Because in the balance sheet, in the business account, in the books of account produced before us for the balance sheet, only business assets are disclosed. His personal assets are not disclosed. So we are mentioning nil on the in spite. We don't know what are his personal assets. An income tax return in case of individual is file of that person, of not of that business. Therefore, if we are auditing only balance sheet of his business or books of accounts of the business and not personal thing, then we should also mention specifically that we are audited the books of accounts of such and such business which are produced for our verification, and we have not audited his personal statement of affair if maintained. I think this is important. So this form number 3CD This is very simple name of the assessee, address, permanent account number. Only one thing is that please check the name of the assessee, address, and permanent account number with the source document at least once. You will find certain minor mistakes, minor correction. For example, name of the assessee as per source document is Dinesh Enterprise, and we are mentioning here Dinesh Enterprises. There can be a case that one assessee's name is Samir Traders, SAMEER, but if we see source document, their spelling is SAMIR. So I think we should verify the name of the assessee and address with the source document at least once. I'll be dealing only with issues rather than discussing the form number, the content of form number 3CD. Here, the assessee is liable to pay indirect taxes. Then we have to disclose the name. Now, what is indirect tax? Because we are supposed to comment upon the indirect tax, whether it is liable to pay indirect tax. So we should know what is indirect tax. Indirect tax is that when we are paying taxes on behalf of somebody. We sold gold to Mr. X, we collected tax from him, and we are paying to government. That is called indirect tax, briefly. Now, what if the assessee is liable to pay particular indirect tax, but he is not registered under the relevant law? If we see the form number 3CD, if assessee is liable, then we have to report his number. But there can be situations that assessee is liable to pay indirect tax, but he is not registered. I'll give one example. A medical practitioner having practice of 2 crore rupees. He has given one small shop for on rent for medical shop. He is getting 5,000 rupees per month. So he is getting 60,000 rupees rent per year. So on which he is liable to pay GST because his total turnover is more than 20 lakhs rupees. But he is not registered himself for GST under the assumption that he is medical practitioner and GST is not applicable to medical practitioner. In this case, at least we have to report. How it is report, I leave to judgment, because what is required, we have to give only a number. But somewhere we have to point out that assessee is not registered under GST Act. It is not required that we should give he should have registered vagara vagara vagara. It is not required. Just mention he is not registered under GST Act. And in another case, what if assessee is liable to register or he is already registered but he is not liable to pay tax? Technically speaking, because of inputs credit, if he is not liable to pay tax, there is no reporting required, technically speaking. But if we make purposive interpretation, then I think if he is registered, then there is no why we should hide the registration number from department. We should always provide registration number in tax audit report. Here also, previous year from to, which I have already explained. Association of persons, and if there is a change in the partners or members. Partners, members, their profit share registry last date of preceding year. Now, certain example, there is a change in remuneration of the partners, whether it is required to be reported. Technically speaking, yes, because remuneration, payment of remuneration to partners is practically speaking appropriation of profit. It is only for the purpose of income tax. One clause, section 40B, we are paying remuneration. But for practical purposes, it is appropriation of profit. But as we are auditing under Income Tax Act, I think if there is change in only remuneration of the partners, it need not be reported. HOF retires and the Karta of the HOF become partner, whether it is required to be reported. Friend, legally speaking, HOF cannot become partner in firm. Legally speaking, HOF cannot become partner in any firm. The Karta on behalf of HOF is becoming partner. There is a vast difference. There is a difference. There is also, I think, Supreme Court decision HOF cannot become partner. Therefore, Karta in his representative capacity is becoming partner in the firm. It has got meaning because even though HOF is partner through his Karta, only Karta can interfere in the affairs of that HOF. Other members of HOF has got no right to interfere in the business of the firm, because Karta is only partner, and that is the understanding between the members of that HOF, that on behalf of this HOF you will be representing the firm for a practical purpose. Therefore, if HO retires and Karta of HO become partner. So there is for the purpose of partnership firm, there is no change partner, because earlier also Karta was partner. Now he has become partner in his individual capacity. For HO, there is no change in the partner. But for practical purpose, from income tax point of view, I think we should report. Technically, we should have practical view. In case of minor partner become major and continues the firm as a partner on the same terms, we should report, because minor was not sharing losses. Now after becoming major, he may not be sharing losses. They may continue the terms same. But earlier he was not sharing losses because of operation of law. Because of operation of law, minor can become partner only for his benefit and he will not share losses. But now he is not sharing losses. That is at their discretion. Therefore, there is a change in term. I think we should report. Now coming to books of accounts, whether book
Sir,
Hello.
yes.
books of accounts, sometimes we have
Yes,
to
sir.
audit.
I think there was some connectivity issue, sir.
So shall I start again from which slide?
No, just this slide only, sir. Before the start of
Just
this.
start
Okay,
your video, sir, first.
Yeah.
okay. See, I am on the books of accounts. We have to audit books of accounts. We have to mention what we have audited and what relevant document we have considered. Am I audible?
Yes, sir, you're audible, but your video is not visible, sir, to us. Your video, sir. Sir, are you listening?
Pardon?
Are you listening to us, sir?
Yes, I am getting your voice.
Yeah, but sir, you are not visible, sir. Otherwise, it's okay, sir. Your screen is also showing. Your voice is also audible.
Yeah, but I am, I think, because I have got my own corner, I am appearing on the screen.
Okay, sir.
Okay, just carry on, sir. No issue, sir.
Okay. You can continue, sir.
Okay. What is relevant document is very important, because in case of petrol pump
Hello. Sir, your voice.
maintain DSR. Audible?
Yeah, now
Sir,
it's
now
audible.
again audible, sir. Some connectivity issue, sir.
Shall I start again?
Yes, sir.
Yeah,
please.
yeah, sir. Yes,
Okay.
sir.
In case of petrol pump, they have to maintain DSR, daily sales report, compulsorily under their law. Then we have to verify, because what happens if you verify daily sales report with your books of accounts, certainly you will find difference. What is happening? The sales are made in cash, and accountant, there can be a possibility that accountant is adjusting sale as per his own convenience. He may not be aware what is mentioned in the daily sales report, which is always verified by the petroleum companies. It is always verified, checked by petroleum companies. And in my opinion, your daily sales should tally, should be in accordance with the daily sales report. Then we have to verify. Even though there is no change in the liter sales during the year, but turnover would change if we are not accounting as per daily sales report, because there is a variation in sale of petrol and diesel rate. Therefore, even in case of fertilizer business, in case of liquor business, so they have to maintain stock record. They have to maintain sales, everything on day-to-day basis. We have to verify our books of account on the basis of those records. So that is also a relevant document. Now, in case of a company, auditor should verify as to whether form number AOC 5 has been filed with Register of Companies under the Companies Act for maintenance of books of accounts at a place other than Register Office. In case of company, if the books of accounts are not maintained at Register Office, because under tax audit report we are certifying the place where books of accounts are kept. And if it is not kept at Register Office in case of company, then we should advise the company to file form number AOC 5 to Register of Companies. it happens sometimes that company, while incorporating company, it is carried on their business from rented premises. Therefore, one address is given as a registered office. With the passage of time, they earn money, they shifted to their own premises, or they, for whatever different reason, they shifted their office. And but they have not changed the registered office at ROC record. Or there can be situation that books of accounts are kept at some different place. What is important, we should verify if you are mentioning that books of accounts are kept at a place other than registered office. We should verify whether AOC file is filed with registered company or not. I have stated in case of composite books of accounts. I think when composite books of accounts are maintained for different businesses or business profession, suitable disclosure must be provided by the auditee. We will verify the entire fact and we will give suitable comment in respect of that in our audit report. Let us have a look at definition of books of accounts, because the definition of books of account is something different and practically something different. If we see definition of books of accounts, books of accounts includes ledger, day books, cash book, account books, other books, whether kept in written form or as printout of data storage in a floppy disk, tape, other form of electromagnetic data storage device. Mark the word as a printout of data storage. So law does not recognize books of accounts maintained on computer media. In case of survey action, in case of survey action, what department can impound or seize impound is books of accounts. They cannot impound, legally speaking, the hard disk which they are impounding, because what books of account has been defined to state that as a printout of data stored on floppy disk, tape, or any other form of electromagnetic data storage device. But this is only a definition which has become outdated, because even Tata company, Mahindra company are not maintaining books of account in written printout format. Whatever auditing is done, it is done online, it is done on audit computer only. What we are doing, it is perfectly right, because it is an accepted thing that data is maintained on electromagnetic devices. Only the amendment is pending in section 212A. I have seen certain auditors, they are insisting for printout of books of account for auditing purpose. I think it should not be done. It is my opinion, because if we insist for printout of Tata company, it will be many trucks of printout. There can be situation that stock records are not maintained. What is auditor role? I have seen many audit report, straight jacket reporting that the stock record are not maintained by the RCC. My question is that whether RCC is required to maintain stock record? If yes, under which law? Because under Income Tax Act, the RCC is not required to maintain stock record. So we verify whether under the liquor business or fertilizer business or any other law, if they are required to maintain stock record, then it is compulsory for the auditee to maintain stock record. In case of, as a point of from auditor point of view, if the business of the RCC is such that we think that he should maintain stock record, then it's okay. But circumstances are like that it is not necessary to maintain stock record, then we should not give loose comment that RCC has not maintained stock record. Because stock records are maintained by the RCC to have its own control on the stock. If business is small, RCC is having perfect control on stock, then why we maintain stock record? I think we should, my point is that we should apply our judgment while reporting as regards stock record. As far as income tax is concerned, there is no requirement of maintenance of stock record. This is a slide which I have already stated that if RCC is having multiple business, he can opt presumptive taxation in respect of one business and he can go for audit for another business. In clause 12, we have to report if there any business on which income is shown under presumptive taxation. So it presupposes that we are auditing of a one business and there is also one another business of which income is shown under presumptive taxation, which we have to report. Yes, this business is shown presumptive taxation under clause 12. Method of accounting. assessee is following cash system of accounting, whether he should account for the closing stock or alternatively can claim entire purchases as expenses. My considered view is that if there is a closing stock, then you cannot claim it as a expenses because closing stock is not expenses. Whatever purchases you have made, you have acquired certain asset. It is a current asset. It is not a fixed asset. What happened? We always see asset as a fixed asset. It is a current asset. It is also a balance sheet item. So the closing stock which is there, I think it should be reduced from the purchases and only net purchases which are consumed should be shown. There is a decision of Pune Tribunal, ACIT versus TJ Naik, in which the Pune Tribunal has allowed the entire purchases as deduction irrespective of the closing stock. Because in this case, department made addition of the closing stock. Department made addition of the closing stock because the assessee was following cash system of accounting. The tribunal deleted the addition for the reason that they are not gone into merit. The assessee is following this system of accounting from years together, and there were also scrutiny occasions where the return of the assessee was scrutinized, under scrutiny assessment was completed, and in which the addition of closing stock was not made. So we are following the precedent. So they are not given view that whether closing stock, whether entire purchases to be allowed or not. But my considered view is that the closing stock is an asset, though it is a current asset, it's a balance sheet item, it will not be allowed as a deduction. Now coming to ICDS 1 accounting policy, we know if we are auditable, then we should follow all ICDS. ICDS 1 decide accounting policy. There is one tagline which is very important, that treatment in accounts shall be governed by substance and not by legal form. I have seen many lectures on ICDS, but I have seldomly seen anybody explaining what does this mean, that accounts shall be governed by substance and not by legal form. Now this has become law. This is very important. Legally you may be correct, but if substance is different, then your legal form would be ignored and substance would be adopted by assessing officer. I'll give one example. What happened? I am selling goods to Mr. X, and again after 3 months I am buying same goods or some part of the goods from Mr. X. While selling goods to Mr. X, I have raised proper bill, I have paid GST, and when Mr. X sold certain goods out of that to me, he has also raised proper bill, he has paid GST. Then this is by legal form we are correct, but substance we have to see when we sold the goods whether we have received money, when we purchase the good, whether we have paid or it is squared up, what is the difference, what is the reason, that is important as an auditor, because we are giving opinion that yes, all ICDs are complied with. There can be situation that even these transactions are made by the parties to increase the turnover for the purpose of bank. We have to give finding. Yes, you accept turnover, but you give finding if there is a turnover with the purchases sale with the same party without squaring up with the through banking channel. You're not giving any opposite opinion. You're not giving any positive opinion, but you're just mentioning the fact. I'm audible?
Yes, sir. You are audible, sir. Please continue.
Yes, okay. So now our responsibility is increased. It is not to verify only books of accounts, purchase and sale bill. We have to see substance. There can be situation that turnover is increased because for the purpose of bank. If we certify without giving findings, if tomorrow something happened, we will be at problem because we are certifying the same. Therefore, my earnest request is that just while auditing, we will see the substance of transactions, not we will go only on legal form. Non-corporate assessee having more than business may adopt cash system of accounting for one business and mercantile system of accounting for another business. This is accepted phenomena, and department cannot impose that you follow same method of accounting for both the business. This is my discretion that one business I want to follow cash system of accounting and one business I want to follow mercantile system of accounting. Now coming to section 43C and 50C. These sections are very complex because it will require 2 to 4 hours only to explain the provisions of section 43C and 50C. But just we will touch upon the relevant position as far as we are concerned. Implication in the case of conversion of stock in trade into fixed asset. Now we know conversion of fixed asset into stock in trade, but here the stock in trade is converted into fixed asset. And in this splendor case, they converted stock in trade into fixed asset. After 6 months, they sold that asset. And they claim capital, long-term capital again, because that asset was there in stock in trade from last 5 years. So what they argued that we are holding this asset for more than 5 years, therefore it is a long-term capital gain, but it was held that we should hold capital asset for we should hold asset for 3 years or now 2 years as capital asset. So it was hold as asset as capital asset only for 6 months, though it was hold as stock in trade for 5 years. So the amount was taxed as short-term capital gain. Now, very danger, there is the insertion of clause 6A in section 28. We know when there is a conversion of stock into asset into stock in trade, if there is a conversion of asset into stock in trade, the same is taxable. The same is taxable in the year of sale. But in case ulta, when stock in trade is converted into fixed asset, it is taxable in the year of conversion. That is very risky because of insertion clause 6A in section 28. Now we will say with one example applicability of section 50C and 43CA. There is one property located in Akola. The consideration is 50 lakhs. Stamp duty valuation is 60 lakhs rupees. The consideration of that property is 50 lakhs. Stamp duty valuation is 60 lakhs rupees. 50C is applicable, 43CA is applicable. If that is held as capital asset, 50C is applicable. If that land is held as stock in trade, 43CA is applicable. But if the land is located at Silvassa, 50C is not applicable, 43CA is not applicable. Because if you read the provisions of section 43CA and section 50C, it is applicable where the stamp duty adopted by the state government. Silvassa is a union territory. It is not a state government. It is controlled by central government. Therefore, in my considered view, the provisions of section 50C and 43CA are not applicable when your asset is located in union territory. Now, another important example, what would be the how income would be calculated when depreciable asset is sold and government valuation is more than the sales consideration. I have given two examples. There is one case and case 2. Open WDV, in both the cases, the WDV, there are 3 buildings, building A, building B, building C, and opening WDV in both the cases is 50 lakhs rupees. Sales consideration of one building, say building A is sold during the year. In case 1, sales consideration is 40 lakhs, and in case 2, sales consideration is 55 lakhs. Stamp duty valuation in both the cases is 60 lakhs. What is to be considered? In case 1, only 40 lakhs would be considered and stamp duty valuation would be ignored. And in case 2, 60 lakhs would be considered. That is, actual consideration would be ignored and stamp duty valuation would be considered. Now, how? We know the WDV is defined in section 43 subsection 6. That comes under the chapter income from business. WDV is defined in section 43 subsection 6 and it is coming under the head income from business. So it is stated that WDV means opening WDV, asset purchased during the year within the same block, sales consideration, less sales consideration, and then closing WDV. In the first case, our opening WDV is 50 lakhs rupees. Sales consideration is asset purchase during the year. There is no asset purchase during the year. Sales consideration is 40 lakhs rupees. Stamp duty valuation, just I'll come to later on. Therefore, closing WDV 10 lakh rupees and you will get depreciation on 10 lakh rupees. Now coming to case 2. Because in case 1, we are there in the chapter income from business, only income from business. Now coming to case 2, in case of depreciable asset. Opening WDV is 50 lakh rupees, sales consideration is more than WDV. Therefore, section 50 of capital gain chapter is triggered. Why it is triggered? Because sales consideration is more than WDV. Therefore, section 50 is triggered. In the first case, section 50 is not triggered. Section 50 is triggered only when your sales consideration is more than WDV. And as section 50 is triggered, section 50C is also triggered. Therefore, in the first case, when sales consideration is less than your WDV, then section 50C is not triggered. But in another case, your sales consideration is more than WDV, the provisions of section 50C are applicable. Particulars of depreciation under Income Tax Act. In case depreciation is not provided in the accounts and same is not claimed in the return of income, whether tax auditor should calculate the same? The answer is yes. Because if we see form number 3CD, it is mentioned depreciation admissible under the Income Tax Act. What is admissible? We should calculate. Whether it is provided in the books of accounts or whether it is claimed in income tax return, we are not concerned with that. Then there can be situation that depreciation on asset used for agricultural purpose. What happened in case of individual? Composite fixed asset schedule is maintained, where there is tractor which is used for agricultural purpose. We are showing agricultural income in our capital account, and by mistake we are claiming depreciation on tractor as well, and total depreciation is debited to profit and loss account. The asset which are used for agricultural purpose, then we should not calculate depreciation on those assets for the purpose of calculation of business profit of the assessee. That care has to be taken. Now here, we have to report upon the entrance fee, club fee, penalty, and other things. Just I will touch about certain issues. Whether penalty paid to municipal corporation for regularizing the extra work is allowed? The answer is yes. Because nomenclature is not important. Here by payment to municipal corporation, if your balcony, if you have covered your balcony and if that is regularized, then it will protect the character of fee. It has been held by Supreme Court in Supreme Court that what is nomenclature is not important. Even though nomenclature is penalty, we have to see purpose. If the work, the wrong done is regularized, then it is not a penalty. What is penalty? If I have contravened the traffic rules, I entered in one way and the police has fined me 100 rupees. So I have paid 100 rupees for nothing. That is a penalty. But if consideration we are getting something, in my opinion, it is not a penalty. So it will not be disallowed. Second, what is important? We have to see whether there is a contravention of law and you are paying for nothing. GST late fee as well as fees paid under section 234E, whether it is disallowable as penalty, my opinion is no. Because it is compensatory in the nature. When provisions of section 234E were challenged in the court, that revenue has got no power to bring this type of section. When there is an automatic levy, it is a penalty. And as per Indian Constitution, before levying penalty, one must be given opportunity to show that his innocence. So there is no opportunity given. Therefore, 234E should be quashed. It was argued by the revenue in the court that no, it is not a penalty. It is a compensatory in the nature. Therefore, if it is the compensatory in the nature, it will not partake character of penalty, and payment of GST late fee 234E, in my considered view, is allowable as deduction. Now, personal expenses of companies.
Hello. Hello.
Sir, we are unable to hear you.
Are you there, sir?
Sanjeev
Telephone
Mutha, sir.
bill is paid of director. It is paid of his residence. It is paid because of contractual obligation. It is business expenditure. It is not a personal expenditure. There cannot be any situation in case of company or personal expenses. Now this section 40A, 40A 1A, I will touch upon certain issues. In case the expense is incurred in respect of business having exempt income, section 40A1 is applicable. Say cooperative society, the income which is directive under section ATP, or there can be a housing project 100% deduction. There can be a company, or there can be a undertaking where income is exempt under section 10A, 10B, like that. So in case there is a disallowance under section 40A1A because of not deduction of tax. So even though there is a disallowance, the whole income will be exempt. For example, suppose net profit is 10 lakh rupees and there is a disallowance under section 40A1A of rupees 1 lakh. So even though there is a disallowance, the company, the assessee would get exemption deduction in respect of 11 lakh. Because what is exempt, what is deductible is a profit taxable under the Income Tax Act. So even profit is calculated after disallowance. It is a profit taxable under Income Tax Act. Therefore, the same is exempt or deductible under the provisions. So my point is that even though there is a disallowance in case of income which is exempt, not chargeable tax, or where deduction is claimed, that exemption is also available to the disallowance. Whether provisions of section 41 are applicable where there is a lesser deduction of tax. If disallowance under section 40A1A can be made in only two cases, when there is no deduction of tax or when tax is deducted and payment is not made. If there is a lesser deduction, section 40A1A are not applicable. Now this is 40A2, not 40A1A. Whether education and higher education sales is allowable as income tax. There is Bombay High Court decision that education and higher education is not income tax. It is not tax on profit. It is calculated on the basis of tax on profit. It is not tax on profit. Therefore, it cannot be disallowed. Therefore, while filing return, we are adding back the income tax paid. Or income tax paid, we are directly debited to capital account. If it is not debited to profit account, at least education sales and higher education sales, we can claim deduction on the basis of Bombay High Court decision. Even income tax appeal filing fees is allowable as an income tax deduction because it is not a tax on profit. It is something different. Income tax appeal filing fees are allowable as a deduction because it is to mitigate, it is instead of mitigation. What is disallowable? It is disallowable taxes on profit only. Section 43 cash payment. It is our misunderstanding that whatever cash payment are there more than 10,000 are disallowable under Income Tax Act. Friend, it is not like that. And that is our understanding or other misunderstanding that only the cases governed by Rule 6D that is not disallowable, but just all other payments are disallowable. It is not like that. We'll take one or two examples. First of all, whether cash payment made to government is hit by provisions of section 43, because in Rule 60B, it is mentioned that payment is made to government and under the rules framed by it, such payment is required to be made in legal tender. So it has been misunderstood by us that payment is required to be made in legal tender means it is required to be made in cash under the rules framed by government. It is not like that. If the intention was that, then it would have been mentioned specifically that it is required to be made in cash. Legal tender means the payment is required to be made. It cannot be adjusted. Example, suppose assessee is a contractor for municipal corporation and he is supposed to receive say 50 lakhs from municipal corporation because of contract work carried out by him. His bill also sanctioned. He cannot adjust his house tax against that contract receipt. He has to tender that house tax. Both are separate concepts. He cannot adjust. So in my view, we have to interpret this provision like this. Now coming to what I stated earlier, whether genuine payments are hit by the provisions of Section 48(3). Genuine payments are not hit by Section 48(3), even though some payments are not appearing in the list of Rule 6 TD, but it is not a case that every payment where cash payment is more than 10,000 would be disallowed. If we read proviso to Section 48(3)(a), 48(3)(a)(3) and Section 43 are one and the same, because in proviso to Section 48(3)(a), reference is also given to Section 43, subsection 3. It states that no disallowance shall be made and no payment shall be deemed to be profit against of business or profession under subsection 3 or subsection 48(3)(a), where payment or aggregate payment made to person in a day otherwise than by account pay check drawn on a bank exceed 10,000 rupees. In such cases and under such circumstances as may be prescribed, having regard to the nature, extent of banking facility available, consideration of business expediency and other relevant factors. Friend, this is a provision of law. This provision of law will supersede the rules 6D. Because in rule 6D, there is no mentioning of consideration of business expediency or other relevant factor. And what is mentioned in such cases under such circumstances as may be prescribed. That has been prescribed under rule 6DD, but may be prescribed, may not be prescribed. If it is not prescribed, this provision cannot be left redundant. The court, the authority has to apply mind having regard to the nature, extent of banking facility available, consideration for business expediency and other relevant factors. If you are meeting other criteria, in my opinion, even though your payment is not covered by Rule 6 TD, the same cannot be disallowed only if two conditions are very important: that payment should be genuine and you should make out a case that what you are required to make cash payment, and this has to be made up to the satisfaction of assessing officer. There are a number of decisions in which even though payment is not covered by Rule 6 DD, it has been held as allowable as deduction. Now, section 14A. This is sometimes ago. This was very important because in each and every scrutiny case, department was willing. They were seeking, or they were behind making disallow under section 14A. Now, 14A has been judicially now settled that 14A is applicable when there is. It is not applicable when there is no exempt income. Even though I have got investment in the asset in the investment, the income of which is not chargeable to tax. But if there is no exempt income, 14A is not applicable. It has been held by Supreme Court. Because assessee is having own funds to cover the tax-free investment, provisions of section 14 not applicable. It has been held by Supreme Court in Reliance Industries Limited. But this provision, this decision is in respect of Rule 60, pre-amended Rule 6D. Now, after amendment, I don't think this decision will hold good, because earlier the interest portion was the major consideration for disallowance. Now, after amendment in Rule 6D, the interest portion has been removed. Whether Section 14A is applicable in a case of deduction under Chapter 6A is claimed by the assessee. My point is that in case of assessee is a cooperative society, income, the entire income of cooperative society exempt under Section 80P, or there can be a housing project where income is deductible under Chapter 6A. Whether Section 14A is applicable, in that case, Section 14A is not applicable, because Section 14A says that income is not chargeable to tax. It is not includable in total income. In the present case, income is included in total income and deduction is claimed under Chapter 6A. So where Section 14 is applicable? The 14 is applicable to the income which are listed in Section 10. If deduction is claimed under Chapter 6A, if even though entire deduction is claimed, 14A is not applicable. Whether depreciation can be claimed in case of sharing profit, yes, depreciation can be claimed because depreciation is not expenses. 14A is not applicable to depreciation. It is an allowance. Applicability of Section 14A where tax-free assets are held as stock in trade. There can be situations that we are held tax-free asset as stock in trade, there were certain decisions in which it is held that provisions of Section 14A are not applicable to when assets are held as stock in trade. But this has been resolved by Supreme Court in Maxcrop Investment Limited. It has been held that even though the assets, tax-free assets are held as stock in trades, provisions of Section 14A are applicable. It has been also held by Supreme Court, even though dominant object to purchase, here it is a case related to shares, or we can refer it to tax-free asset, is not relevant, because in the case the shares were acquired to have a controlling interest. So there was no purpose to make investment. But Supreme Court held that whatever may be the situation, the income is exempt, therefore Section 14A is applicable. Now here I will refer to clause 25, any amount of profit chargeable to tax under Section 41 and computation thereof. We know if we have claimed deduction of any expenditure in earlier years, and if we got any benefit during the current year, maybe we got discount, a certain amount is refunded to us. So it will be taxable because we have claimed deduction in earlier year. But there can be a situation that we have shown sundry creditor of one person from last 5 years. We have claimed purchases and deduction. We are showing sundry creditor in our books from last 5 years. Neither we are making payment, nor that creditor is demanding money. There can be again two situations that the creditor is also showing the same amount payable to the assessee. For example, I have shown 10 lakh to be payable to Mr. X from last 5 years. I am not paying that 10 lakh to Mr. X on account of sundry creditor, and Mr. X is also showing my name as sundry creditor, that 10 lakh receivable. In that case, the 41(1) cannot be invoked. Now, what would happen if I am showing payable of rupees 10 lakh to sundry creditor Mr. X, but Mr. X is not showing any amount receivable from me? In that case also, the disallowance or the addition cannot be made under Section 41, because even though the debt has barred by law of limitation, the income tax is a self-contained code. I am showing that it is my will that I want to pay this amount. What is important? My will. Whether Mr. X is showing in his books of accounts that amount received from me or not, it is irrelevant. It is my honestly I believe that I want to pay this amount, and because of such and such problem, I'm not paying this amount, but I want to pay. But what is important? This statement should be genuine one. You should make out your case. You cannot make statement I want to pay just for the sake of convenience. Section 41 is not applicable if losses during the respective year. Now, what happened in case where the purchases were made, if there were losses during that year, or if income of that year was not chargeable to tax? I'll give you example, cooperative banks. Once upon a time, the income of cooperative banks were deductible under Section 80P. So some purchases were made during the year when there was deduction was available to cooperative banks. If those purchases were not accounted for during the year, then that increased profit would have been claimed deduction under Section 80P during the said year. But purchases were shown during the said year, and now that purchases are written off in my books of accounts. It will not be chargeable to tax under Section 41 because I have not taken any benefit. I have not taken any benefit. If there were losses during the said year, the court have taken practical. The Pune Tribunal has taken practical view that there is no benefit obtained by the assessee. What is the purpose of Section 41? That assessee has obtained some benefit, and then if he has obtained benefit by of deduction taxes in some year, then in case he got benefit, if the amount is realized, then he should pay taxes in the year when he has realized that amount. This 43B, I think this is very, very important. Instead of explaining procedure, we'll go to example directly. Now, employees' contribution to Provident Fund. Now, this is a case where CPC is disallowing the employees' portion to contribution to Provident Fund if it is not paid within the due date as prescribed under Provident Fund Act. They are making addition, the rectification applications are disallowed. In spite, there are n number of decisions, 1 or 2 decisions are against, but there are n number of decisions, almost all courts have held that the said expenditure is allowable under Section 43B. Fred, employee's contribution is income because of section 224, income of definition of income. This is income. Then under section 36(1)(3), it is disallowed by invoking section 36(1)(3). But 36(1)(3) in respect of expenditure, it is not in respect of disallowance. If the intention was legislature was to completely disallow the same, they would have made provision under section 40(f), which start with the heading that amount not deductible. There is no provision under section 40A, that is, we know TDS is disallowed, 40A 2B excess payment to release are disallowed. So there is no provision in the section 40, and the provision is made under section 36 when section up to 37 are related to deductions, not disallowance. Thirdly, there is no rider. If the intention was the legislature was that this employee's contribution should not be allowed at all, they would have mentioned specifically. If we refer to section 69C, unexplained expenditure, there it is specifically mentioned that the addition made under section 69C will not be deductible under the provisions of this act. If there is an unexplained expenditure, if addition of that unexplained expenditure is made, then it has been mentioned in section 69C that the deduction of that expenditure cannot be claimed under the provisions of this act. So there is no such provision in respect of employees' contribution. Secondly, section 43B overrides entire provisions of the act. It starts with the non-obstante clause that notwithstanding anything contained in the provisions of this act. So in this 43B overrides section 224 and 36(1)(3) as well. Therefore, under section 43B, the deduction allowable. Now, technically speaking, if we refer to clause B, it states that contribution under Provident Fund Act payable by the employer. The employee's contribution is always paid by the employer. They may deduct it from salary. If it is not deducted from salary, it is paid by the employer from their own pocket. So it's a liability of employer to pay that contribution. The provisions of section 43B are applicable to the contribution payable under Provident Fund Act. So it is a contribution. It may be related to employee or may be related to employer. So section 43B is well applicable. In case of disallowance, kindly file appeal. You will get relief in our favor, and I hope so. Now, to better understand the concept of section 43B, I think in some cases it has been misunderstood. I have taken one example. Friends, kindly just give attention. There are GST has passed order for financial year 17-18, 18-19, and 19-20, maybe certain period of 19-20. They have passed order, there is certain demand for these 3 periods. Now, in first case, the orders are passed in the month of March 2020. In the first case, the orders are passed in the month of March 2020. Provision is made in the books of accounts of March 2020. The payment is also made in March 2020. It is allowed as a deduction. Now, in second case, orders are passed in the month of March 2020. Provision is made in the books of accounts, yes, and the payment is made before due date of filing of return of income. That is now November. It is paid before due date of filing of return of income. The expenses are allowed. In the third case, orders are passed for these 3 years in the month of March 2020, but provision in the books of accounts is not made. But it is paid before due date of filing return of income. Still, it is allowed, in spite provision in the books of accounts is not made. I will explain how. In the fourth case, that is important. The orders are passed in the month of April 2020. Provision is made because books of accounts were open. So entire provision is made for the demand rate for the financial year 17-18, 18-19, and 19-20 as well. And the same are also paid before due date of filing of return of income. But the entire sum would be disallowed, including the demand rate for financial year 19-20, and we are also auditing for the financial year 19-20. How? If you read the section 43B, it starts with the non-obstante clause, notwithstanding anything contained in the provisions of this act, a deduction otherwise allowable under this act in respect of so and so. They are given item. There are 8 items. some provident fund, etc., shall be allowed irrespective of the previous year in which the liability to pay such sum was incurred by the assessee according to the method of accounting regularly employed by the him, only in computing the income in the year in which it is paid. So your method of accounting, your liability is irrelevant. It is allowed only in the year in which paid. So as per this provision, there are two limbs of section 43B. There are two limbs of section 43B. Both the limbs are very important. First of all, we have to see whether payment is made during the year, irrespective of the year to which it relates, it is allowed as a deduction. Because of section 43B, it has got overriding effect over the entire act, irrespective of your method of accounting. Now, secondly, if payment is not made during the period, during the year, that is, payment is not made before March 2020, then the proviso we have to read. What proviso says, provided that nothing contained this shall allowed, and if the payment is made before due date of filing of return of income under section 139(1) in respect of the previous year in which liability to pay of such sum was incurred. Mark the word, payment is made before due date of filing of return of income under section 139(1) in respect of the year in which liability to pay was incurred. In the present case, as far as clause 2 and clause 3 are concerned, liability was incurred during the year, during the March 2020. Therefore, provision is applicable that payment can be made before due date of filing of return of income. So in clause 3, provision was not paid. Provision was not made. In spite of that, because of proviso, it is fulfilling condition that liability is incurred in the month of March 2020 and it is paid before due date of filing of return of income. There is no mentioning whether you are provided in books of accounts or not. You will get deduction because of section 43B. But in case of 4, the liability is created in the month of April 2020. It is not created in the month of March 2020. This is very important aspect. Liability is created in the month April 2020. It is not created during the year under review. Therefore, even if payment is made, deduction is not allowed, because what act is saying, irrespective of method of accounting maintained by you, even though you are following mercantile system of accounting, as far as the items which are covered by section 43B shall be allowed only as per provisions of section 43B. So I repeat, if liability is not raised in the month of March up to March 2020, even though it relates to the year 1920, it will not be allowed if liability is raised thereafter. Is commission paid to employees covered under section 43B? I think many of us think that commission paid to employees is not covered by section 43B, but my view is different. In my view, commission paid to employees is also covered by section 43B. That is our misunderstanding that provisions of section 43B are applicable to bonus. Nothing is mentioned in respect of bonus in section 43B. What they are mentioned at clause C, any sum referred to in clause 2 of subsection 1 of section 36. Section 36(1)(2), we always refer for bonus, but it also contains bonus and commission paid to employee. Therefore, in section 43B, they have made reference to the clause 2 of subsection of section 36, and in section 36 subsection 1 clause 2, it relates that bonus as well as employees commission. What is happening? I have seen some cases, the commission is provided in the name of employees because TDS is not required to be deducted unless the salary and commission exceed the limit of 5 lakh rupees. Because commission paid to employees is treated as salary under section 16. So it is not a commission as per section 194I. Therefore, it is a salary, and if it is salary, so TDS is required as per as treating it the said commission as salary. If the salary and commission is less than 5 lakh rupees, the TDS is not applicable. Therefore, certain adjustments are being made by showing commission to employee. But if that commission is not paid before due date of filing of return of income, it is also hit by section 43B. I have already covered employees and employees contribution 43B. Whether deduction is allowed under 43B in case of bank guarantee is furnished, there can be situations that I am not in a position to pay sales tax or GST or bank interest or any other sum or provident fund. So for that purpose, I issued bank guarantee to sales tax department or to provident fund. So deduction will not be allowed as held by Supreme Court. There can be situation that the interest is converted by bank into loan. It will not be treated as payment of interest, and if section 43B would be triggered, and even the bank guarantee is given or interest is converted into loan, the same will be disallowed under section 43B. Now, one more interesting example. I have taken three items: GST for March, provident fund for March, and interest on loan. GST for March, provident fund for March, and interest on loan. See, due date for GST is 20th April 2020. Provident fund is 21st April 2020. Interest on loan I assume to be on 2nd April 2020. All the payments are not made on the due date or before 31st. Even those payments are not made before the due date under section 139(1). Whether 43 would be applicable, my opinion in case of GST for March, even though it is not paid before due date of filing return of income, yes, it will be hit by section 43B. But as far as provident fund and interest on loan is concerned, my opinion is that 43B section is not applicable. Why? If you read the provisions of section 43B, it says clause A, any tax payable, any provident fund payable, interest payable. See, there is a difference in liability and payable. GST provident fund for the month of March is the liability on 31st March 2020, but those were not payable on 31st March 2020. Those were, it has been held by court that the due date is 20, therefore it is payable on 20. You can pay up to 20. Provident fund due date is 21st of April, therefore it is payable on 21st, and there is a liability on 31st March only. It is not payable. Therefore, provisions of these sections are not applicable. Then why it is applicable to GST? Because there is insertion of provisos explanation 2 in section 43B. It has been stated that for the purpose of clause A, the liability would be treated as payable. That is only for the purpose of clause A GST, because when the explanation was inserted, there were only two items: tax, duty free, and provident fund. But for provident fund, there was provision under the 43B that if it is not paid before the date as per Provident Fund Act, it will not be allowed. Now that has been removed. Therefore, now the government has forgotten to make further amendment to include other payment also. Therefore, if we read, there are also decisions in this in favor of this view. Only because of certain decisions, the expression 2 was inserted, stating that for the purpose of clause A, the amount liability on 31st March shall be regarded as amount payable. But there is no such corresponding amendments or provision in respect of other payment provident fund. Therefore, if we apply the ratio laid down by certain courts as well as this explanation, the provident fund or interest on loan for the purpose of March, which was not payable on 31st March, if there was a simple liability on 31st March, the provisions of section 43B are not applicable. Now, this is earlier year's expenses. What happened? As the auditor, sometimes what we are seeing, we used to see the bill. Bill is dated March 2019. It means pertinent to earlier period, and the services or purchases are also obtained during the earlier year. Therefore, we treat the said expenditure as pertinent to earlier period. Friend, this is not the criteria to decide whether payment or expenditure is pertinent to earlier period. Even though bill is related to earlier period, bill is dated up to earlier period, the expenses also pertain to earlier period. But if bill is received during the year under audit, so it means it is the expenditure of the year because it is crystallized during the year. There are n number of decisions. because I came to know about this expenditure, exact amount of expenditure in the current year, except if the department can make out their case that you were knowing this expenditure along with quantum. For example, I have entered into contract with some vendor for monthly maintenance. I pay him monthly rupees 5,000 rupees. So I know monthly there is my liability. Then I should provide for the same. But in case if you make out the case that I received bill in the month of April, May, June, July in the current year, though pertain to earlier period. Therefore, it is crystallized during the year and it is not an expenditure pertaining to earlier period. So while auditing, we should have this type of broad view, I suppose. Clause 29A. Whether any amount is to be included as income chargeable under the head income of other sources, other income as referred to clause 9 of section 56(2). It means if we have received any advance against sale of capital asset, if that advance is forfeited, then it is income under section 56. But if we receive advance against stock in trade, if it is forfeited, then section 56(2) is not applicable, but section 28 is applicable, because if you receive advance in the course of our business, if it is forfeited, it is a business receipt, it is taxable under section 28. But what happened if I receive advance against sale of agricultural land, the agricultural land which is situated more than 8 kilometers away from the local limits of municipal corporation, and it is not capital asset under section 240. A agricultural land which is not capital asset under section 2 subsection 14, if I received advance against that agricultural land and it is forfeited, it will not be income. What is income? Only advance received for sale of capital asset. If the asset is not capital asset within the meaning of section 240, then advance though forfeited will not be income under section 56. Now 56 to 10. We know if any property, whether cash, movable property, immovable property is received from non-relative for without consideration or for less consideration, then the difference is chargeable to tax under section 56 to 10. Now I refer here, I want to make out a case in case of immovable property, land, building or both. If it is held as stock in trade, then provisions of section 56 to 10 is not applicable. It is applicable to only capital asset. Because I come across one case, it was reported by an auditor that even though it is stock in trade, there was difference in actual consideration and government valuation. Difference was reported. So in my considered view, section 56 to 10 is not applicable to the immovable property which is held as stock in trade. Now, expenditure during the previous year by way of interest similar nature, 94B. This also came in abeyance. 269 SS loan. ST. This is a new clause, 216 ST. Only one thing is that if any cash is received on single day or get one transaction or in respect of occasion, any single occasion, exceeding rupees 2 lakhs, the penalty would be levied in because that would be held as in contravention of section 269 ST. Yes. We are supposed to fill up this chart. This is very easy. Only one thing is pending in this case, that if amount is not, if TDS is not deducted, then there is no reporting required under clause 14. It is applicable only to two states of cases, whether TDS deducted not paid and whether TDS is partly deducted. It is applicable to only two aspects, and if TDS is not deducted, there is no reporting is required under clause 24. Deemed dividend. This is also very important aspect. Now we are supposed to report whether assessee has received any amount in the nature of dividend under section 222E. We have to understand the provisions of section 222E because there are many instances where the assessee has received amount from the company in which they are having interest, and it is being treated as deemed dividend. Earlier it was ignored because there was no reporting required under CCD. Now because of requirement of reporting under CCD, what would happen? We will report any amount received from the company, treating as a deemed dividend. In my opinion, every amount received from the company is not deemed dividend. There are exceptions to this rule as held by courts. Because we have to calculate accumulated profit, possession of accumulated profit on the date of transaction. So there are difficulty. Instead of quantifying, if you are getting difficulty, I think we should mention difficulty in the absence of, if you're not auditing the books of that company, you can mention that in the absence of record of that company, I cannot comment. Who is to be tax register holder or beneficiary holder? I think this is a separate topic, but I'll share this PPT with you. So we can go through the decisions. We can decide where it is taxable, it is not taxable. Intercorporate deposits are not loans and it is not subject to 222E. Advances made in the ordinary course of business for business exigency is also not treated as deemed dividend. And transaction in the nature of current account with director also held to be not covered by section 222E. This is the new insertion from 1st October 2020. We know tax audit report is changed at 3 places. This is important when our client auditee is company. We have to mention whether assessee has opted, he has exercised his option for taxation under section 115BA, 115BAA, 115BAB. What is BA? If the company has commenced new company after 2016, then provisions of section 150 were applicable, where tax is 25%. 115BAA, that is that now it is introduced from assessment year 2021, and their tax rate is 22% plus surcharge. And in case of 115BAB, where the company is set up, newly commenced after October 2019, then tax rate for manufacturing purpose, their tax rate 15%. So here what is asked, whether assessee has opted for taxation under section, those sections. We have to report in tax audit, whereas this option is given to give exercise option before due date of filing of return of income. Here audit is to be completed before 31st October and due date is 30th November. If assessee has not opted, we cannot say whether he has or no, because he has not taken decision, because he will take decision at the before due date of filing return of income. We have to complete audit before that. I think even if we have to audit before that, we will have to take decision whether we want to go for 115BA, 115BAA, 115BAB, because it will the other amendments, that is clause 18, reporting depend upon our option what we have exercised. So if we have exercised option that we want to go for 115BA, 115BA or BAB, then we should mention yes. If not, if no, I don't know what is there in utility, not applicable or is there in mention. Then if option is not exercised by the assessee, then we will mention in form number 3CA that still option is not exercised. But in case of section 115BAA, if option is exercised, we have to recalculate the WDV because the additional depreciation is not allowed under section 115BAA. But additional depreciation, if it is brought from last year, it is also not allowed. As it is not allowed, to that extent, we have to increase the WDV, opening WDV, that is reporting under clause 18. Whether tax audit can be revised? Yes. Our guidance note issued by institute has stated that if there is a revision in the accounts of the company, if there is change in law, when there is a change in interpretation, we can revise the tax audit report. Even if there is any mistake or incorrect statement in the tax audit report, we can file revised tax audit report, and we can also revise the revised tax audit report. It is allowed under the utility provided by Income Tax Department. We know we have to obtain for unit identification number. Disclaimer. And thank you so much, friends, for giving patient hearing. Thank you so much. I think I have followed the time. It is exactly 7 o'clock.
Yes, sir. Perfect. All the participants are requested to raise your query for the today's session. If you are having, Sir Mutha sir can solve your query. If anyone wants to ask anyone, please unmute yourself and ask your query. I think nobody is asking the query. Now I request Vipul sir to take over the charge. Vipul sir.
Yeah, sir. I'm here only. Thank you, Kiran sir. Thank you, Sanjeev Mutha sir, for explaining the audit entire provision with lots of case studies, sir. It was very in simple language and lucid language. You have highlighted the various provision, and most importantly, sir, you have highlighted about the cash transaction exceeding 5%. I think it will be very important in arriving the decision of applicability of tax audit for the particular assessee. Sir, you have covered this issue with lot of case studies. I think a member will benefit from that examples. And apart from that, sir, you also highlighted about the various other reporting requirement, like particularly in case of petroleum company, you said you must verify with the daily sales report as required by them. Apart from that, also stock record maintenance requirement you also highlighted for the fertilizers company, for the liquor company also. AOC 5 requirement for the company assessee. And most importantly, I think, sir, you highlighted about the accounting policies adopted by the assessee should be governed by its substance and not by legal form. So very, very important, I think. And apart from that, you also covered the applicability of section 50C and 43CA relating to the conversion of stock in trade. You, sir, also highlighted about the depreciation requirement. In case depreciation is not charged by the assessee, then it is our duty to charge the depreciation. So thank you so much, sir, for sparing time with us and guiding our member. And I'm sure all the members who have participated today will be highly beneficial from your deliberations. Thank you so much, sir. And last but not the least, thanks to all the participants from all the 3 branches and nearby region who have joined and made this program very successful. And just little announcement, we are having another important session on newly introduced TCS provision. That is much talk going on about this session. Very expert faculty from Mumbai, CA Bhupendra Shahji will be guiding. Registration is already
tomorrow, sir. I want to join.
Yes, sir, please.
Yes, sir. Tomorrow we are having a session on TCS